So we're going to start off by going over here. And if you've been on a webinar of ours, or at least a couple of them, you've seen this image before. And this image is important to be able to understand what is happening when you are buying or selling an option.
Please subscribe to our channel. Have fun trading!
And it's super important to understand that, because that is setting up your direction, right? It's you're either going to be bullish, bearish, or neutral when you're doing something. And then if you are buying an option, you're going to have a right, and if you're selling an option, you're going to have an obligation. Okay, so I'm going to break this down as two sides. Okay? And if you've been on the webinar before and you've heard me use the analogy that if you are the buyer of an option, then you're like the purchaser of insurance. If you're the buyer of an option, you're like someone going to Geico and buying insurance. And if you are the seller of an option, you're like Geico. Okay, you're running a one woman or one man insurance company. So, but another way to look at it is that if you are a buyer of an option, then you have a right and not an obligation to do something. Okay? You have a right, but not an obligation to do something. When you go to an insurance company, if you buy insurance from, let's say, Geico again, and you get into a fender bender with your car, you have the right but not the obligation to let Geico know. Okay? You don't have the obligation to let them know that you got in a fender bender. You can just get that fender bender fixed yourself and not file a claim, so it won't go on your record and so forth. Right? And a lot of times that's what people do. Right? They say, okay, it's barely more than my deductible, or whatever the case may be. I'm just going to get this fixed, or it's less than my deductible, but they do still have the right to have Geico fix it. Okay? They still have the right to have the insurance company fix it, but they don't have the obligation once again. So that's how you can kind of think about it when you're in the option world. Okay? Is that the buyers have rights and not an obligation, right? So you don't have a right to, or an obligation to do something. The seller, though, has an obligation to do something. So that's why it's important to understand when you're doing a certain type of trade, if you're buying or selling, that do you have that right, or you have that obligation? If you're the seller, you're going to have an obligation, and normally that has a negative kind of connotation to it. When someone says you have an obligation, right? At least in my opinion. But if you go back to what I originally said, is that the seller is the insurance company. So this is not a negative to have an obligation when you're the option seller. It's not something bad, because if you're the seller, you have the probabilities on your side, just like the insurance companies have the probabilities on their side. Okay? And they have the probabilities on their side because they determine who they're going to insure, and then they decide if the person is going to be a low risk, and then they'll most likely charge them less, or if someone is a high risk, they're going to charge them more or not even insure them at all, right? So that's how they kind of make sure the probabilities on their side, by doing a due diligence before they insure somebody.
Please subscribe to our channel. Have fun trading! Make that money! Make that money! Make that cash and blaze! And manage your risk.
So if you are the call purchaser, if you're buying a call, right, you are bullish, as this arrow indicates. You want it to go up. You're super positive on the underlying. You are buying a call to benefit from something going up. Okay? And when you are the buyer of a call, then you have the right to purchase at a strike price. We're going over the basics, and we're going to use the safeguard strategy to kind of walk you through this. But if you are the buyer of a call, you have the right to purchase at a strike price, but you don't have the obligation. So, but usually, if you're the buyer of a call, you're going to exercise your right only if the stock is up significantly. Okay. But most of the time, you won't even do that. You'll just take the profits from the buying of the call. So, for example purposes, I'm just going to use this over here. Let's say when you bought the call, the stock was trading at $100, and the call that you bought cost you $3. Right? So you need it to be higher than 103 for you to make money on the call at expiration. But let's just say at expiration it's trading at $110. So you've made, from the difference from the 103 to the 110, you've made $700. Okay? So you could decide to take ownership. You have the right to take ownership of the stock at the 103. But most people just walk away with their $700 profit and they move on. Okay? But you do have the right, but not the obligation, to buy it at 103. Most people would just take, once again, the $700. So you have the right to do that. When you are the buyer of the put, then you have a right to sell at a certain strike price, but not an obligation. Because when you're the buyer of a put, you're paying monies because you're the buyer, and you have a right to sell. Because buying of a put, you're negative, you want it to go down, as arrows indicating. It's the opposite of when you are the buyer of a call. And when you're the buyer of a call, you're bullish. When you're the buyer of the put, you're bearish. So the same kind of example can be used on the put side. So you're the buyer of a put at $100 strike, at the $100 strike. You paid $3 for the put. Okay? So you need it to be below 97, right, before you start winning at expiration, because you paid the $3 that we were talking about before. Okay? But if it drops to 90, okay, if it drops to 90, then you'll make the difference from 97 to 90 at expiration, if it's at this 90 at expiration. So you would once again make the $700. But you do have the right to sell the shares at 97. You can exercise that right to sell the shares at 97. That means go short the shares. Okay? So it's the same kind of concept of buying the shares. It's just the opposite. And you have the right to do that. But most will just take the profit from the put falling, the $700. Okay? So you have a right, but not the obligation. Bear with me here. If you have any questions, please interrupt. I want you to understand this at a very high level. We're just talking about the first pillar of what we believe is three pillars of the base of options. We're talking about the call and the put, and what's happening when you buy or call and the put. You have to know this at a high level to have a solid foundation of the basics of options. Okay? So this is what's happening at this point. We just talked about the buying of an option. Okay, you have the right, but not the obligation. Now, if we talk about the selling of an option, then you have an obligation. So if you're the seller of a call, then you want it to go down, as this arrow is indicating. You're bearish on the underlining. You're trying to make money as it goes down. But you have an obligation to provide shares to a buyer at a strike price. So if you sell this once again at $100 strike price, okay, and the stock goes up to 103, okay, it goes up 103. I mean that let's say someone paid you $3, right? So someone paid you $3. So you don't, as long as it doesn't go past 103, you're going to win. You're going to break even or win as long as it doesn't go past 103. But if it goes to 110, then you're going to lose $700. The buyer is making $700. The seller is going to lose $700 in this case if they sold this 100 strike. But if the buyer exercises their right to purchase at the 100 strike, right, then you have to provide the shares to the buyer at the 100 strike. You're still only the most you can lose in this scenario is 700, but you're going to have to buy the shares and provide them to the buyer at the 100 strike. That's your obligation. You're not going to, the brokerage firm is going to do it automatically for you and so forth. That's just going to happen. If you don't have the monies in your account to do it, then they're not going to allow that to be the case. So you don't have to worry about going to find the shares and all that kind of stuff. It's going to happen automatically at expiration, or if it's assigned before expiration. Okay? But this is kind of the difference of what's happening. Okay? You have one side is the buyer, one side is the seller, and it's just the opposite of what's happening. Okay? So if you are the seller of a put, then you're bullish. You want it to go up, right? You're bullish. You want it to go up, and then in this case, you have an obligation to buy the shares at a certain price, okay, at the strike price. So if you sold a put at $100 strike price, and now someone once again paid you $3, and it drops to it's this is the 97 break even price, right? Because someone paid you $3, so it can drop to 97 and you'll still be fine. You'll break even if it dropped to 97. But if it drops to 90, then that's where you're going to lose that $700 we talked about. But you have to buy the shares. You would have to buy the shares at 100, the 100 strike, and it's now trading at 90, and you received $3 initially this here, so that means you're down $700. But you have to buy the shares at the 100 strike. That's the kind of obligation you have, is to buy at a strike price. Okay? You're bullish when you sell a put, but you have an obligation to purchase shares. You're bearish when you sell a call, and you have the obligation to provide shares to someone, right? To sell shares to someone. One is purchasing shares, one is selling shares to someone. One last thing about this before we start to jump into this and kind of see these calls and puts through the lens of the safeguard strategy. It's important to understand that you can be bullish or bearish using only calls or puts. So for example purposes, if I was bullish, I can buy a call. Okay. If I was bearish, I can sell a call. Okay? So you have this kind of circle going, that I can either be bullish or bearish using a call. It all depends on what I'm doing. If I'm buying the call or selling the call. Okay? So if someone came to me and they said they were doing this new strategy that was called the rocket ship, and they told me that they were on the call side and it was a net credit, I would instantaneously know that that is bearish. Okay. I don't need to know what strikes they purchased or sold or whatever the case may be. I just know they told me that the strategy is called the rocket ship, and they sold and they received a credit for those calls that they did. Well, then I know immediately that that is bearish, even though they might think it's bullish, right? They might think it's bullish because the image of a rocket ship is going up, right? They might think it's bullish. I would know instantaneously that it's bearish, and vice versa. If someone came to me and said that they were really negative on something, and they were using calls, but they it was a debit that they paid for it, it was a debit, then I would know they structured that trade incorrectly, that's more bullish than bearish. Okay? Now, the same kind of concept is on the put side. You can be bearish by buying a put, and you can be bullish by selling a put. right? Same type of circle here again. Right? Same type of circle. Doesn't matter. You don't know what someone's doing if they say, I hate calls. I just use puts. That doesn't mean they're always bearish. It doesn't mean they're always bullish. You don't know, right? And then you can use a combination of these things, right? So if I sold a put and bought a put at the same time, what's happening? If I buy a put and sell a put, what's happening, right? Or if I use all four of these type of strategies, what's happening? Right? And then it's going to depend on if it's a credit or is it a debit, right? So you got that. You want to know what's happening when you are buying and selling a call and a put, or buying and selling them both in concert. Okay? All right, so let's move on, and that's now kind of jumping this at a little higher.